This article is coming from CNBC. 10-year Treasury yield hits highest level since November. U.S. Treasury yield rose Tuesday, according to their sharp February gains, as traders weigh the prospects of higher, tighter monetary policy for longer. The yield on the benchmark 10-year Treasury note was up around 3 basis points. Earlier, it touched a high of 3.983%, its highest level since November 10th. The 2-year climbed slightly to 4.8% after reaching its highest level since November on Monday. Now, the 2-year yield is what the Fed Powell is chasing. This is going to dictate where interest rates go. All right. Those gains come as traders increasingly bet on Federal Reserve rate staying higher for longer, as recent data points to persistent inflation. So we had a couple of reports come out in January, and they all were higher than expected. Core personal consumption expenditure price index rose in January from year earlier period, beating expectations. The overall PCE index advanced year over year, also more than expected. Right. So let's go to the 10-year Treasury note, which is the benchmark for bonds. All right. So let's just go to the daily chart. Right. And what you can see is that since the pandemic, the yield has increased on the 10-year bonds, right? You know, that's when the Feds flooded the markets with money, and there was more money chasing fewer goods, right? And that's how you get inflation. Now, this is November. We had a pullback in the yield, and potentially we're going to go higher, right? Because that's what price does. You go up, pulls back, up, pulls back, up, pulls back. All right. You could also say on the monthly chart, you have this bear flag setting up. Now here's the cool part. Why did prices pull back at these levels here? Let's see. See these pivot lows back in 98 and 01. Price has memory. Pivot low, pivot high, right? My point goes directly to the 4.5 level because of this M pattern here. An N pattern is a bearish formation, and then we broke this low. But here's where I'm interested. So let me bring that across. Okay. And since we're on the monthly chart, we're going to color code that orange, yellow. Okay, let's go to the weekly chart. Again, in November, that's when we saw the recent highs. But again, I'm not shocked, right? This is what price does. Goes up, pulls back, goes up, pulls back, to potentially go higher than the previous high. Here was an interesting level here. Alright, let's see what that area looks like. Actually, let's go to, yeah. Okay, let's go down to the daily chart. So this red candle represents Friday. And what happened on Friday? Stock market rose. All right. So lower interest rates means higher profits for companies, and that's why we saw the stock market, equity market rally. I also like this area here. Let's see if it hit. All right, so we're going to mark that as daily sellers at the .15%. Okay, so I would anticipate as price moves higher, we'll get a pullback, but eventually this area is going to be breached, right? Because price needs to go and seeking out high time frame levels. All right, let's go over okay, I don't have enough data. Going back to so this is what I would anticipate over the next couple of weeks. Price is just pulling back to the 13 simple moving average to go higher. It's going to hit this 4.15 daily sellers level. It's going to pull back to go higher. It's going to breach this zone and take out the recent pivot highs in November and October. We should see price get to 4.5. So I'm going to mark that as the target. Midterm target 4.5%. So interest rate news is going to remain in the headlines because that's what Powell's trying to tame. But I think interest rates are going higher. Until next time.